SSMRV College presents video lectures and ISR initiative. SSMRV College, one of the premier institutions run by the prestigious RV group of institutions, has come up with a unique initiative to engage students at a time of this unforeseen medical emergency caused by corona outbreak. As a socially responsible institution, we would like to connect academically with students to make good the losses caused. In this connection, I, Salma, Assistant Professor, Department of Commerce, has posted a video on the subject Advanced Corporate Accounting, and the topic is Internal Reconstruction. Please watch the video till the end and like. Share with your peer groups and subscribe to our YouTube channel. Thank you. Internal reconstruction. Internal reconstruction is an arrangement by the companies whereby the claims of shareholders, debenture holders, creditors and other liabilities are altered and are reduced so that the accumulated losses are written off. Assets are valued at its fair value and the balance sheet shows the true and fair view of financial position. So internal reconstruction is basically concerned with the complete overhauling, that is nothing but the restructuring of financial position of a firm. The main purpose is to improve the profitability of the existing company. There will be so many reasons which arises the need for internal reconstruction, or as financial position does not show a true and fair value. That is the reason we have mentioned that assets are valued at its fair value and the balance sheet shows the true and fair view of financial position. Assets do not present true book value sometimes, overdue outside liabilities and inflated share capital. Thus, recognize the company by revaluing the assets, reduction in liabilities and capital through internal reconstruction. Hence, no new company is formed. Therefore, it only involves the internal reconstruction or restructuring or reorganization of the company. Nothing but it involves the issue of fresh shares. We have two types or forms of internal reconstruction. Internal reconstruction may take any of the following two forms. The very first, reorganization or alteration of share capital. It refers to the rearrangement of the capital of the company. This can be done in a way by either consolidation or division of shares into new classes. The changes in the existing capital structure of the firm, which may include the various reasons. Next, reduction of share capital and other liabilities. Let us have a discussion on two different forms of internal reconstruction. The very first one is reorganization or alteration of share capital. This refers to the rearrangement of capital of the company. The rearrangement refers the capital of the company which can be done in a way by either consolidation or division of shares into new classes. In the simple way we can say alteration of share capital refers to the changes in the existing capital structures of the firm and includes the following. There are the various reasons where we can have the rearrangements, like increasing the share capital. How we can increase the share capital? In the sense we have an option by making fresh issue of shares. And decreasing the share capital, this can be done only by cancelling the unissued shares. When these two two different options if we use, this definitely give a reorganization and the company can recognize how the profitability can be maintained. So the other point it says conversion. Another point also helps in alteration of the share capital by converting the shares into stock and stock into shares under various circumstances, and consolidation of shares of a smaller amount into shares of a larger amounts where the nominal values will be used and to rearrange that to give a fair and a correct picture in the financial statement. And another one is by subdividing the shares of larger amount into smaller amounts. This is also a division of share capital into the different classes. So the second alteration and the rearrangement of capital of the company is reduction of share capital and other liabilities. The amount made or whatever the amount or the retained earnings made available by the capital reduction is utilized in return of the accumulated losses, fictitious assets and other overvalued portions of other assets. Whatever that is left out in case if we have maintained the capital reductions by using all these options, it can be transferred to the capital reserve. This will be made or this can be utilized and current there is an accumulated losses and fictitious assets and overvalued portions of other assets can be utilized, and what is left out will be utilized only at the time of any emergencies or any future contingents. So this is what it tells us, and here return of the accumulated losses. What these accumulated losses are which can be written off by utilizing the capital reduction. Accumulated losses are nothing but the negative return earning balance or deficit arises when cumulative amount of losses experienced and dividend paid by a business exceeds the cumulative amount of its profits. And the fictitious assets. Let us also know what these fictitious assets are. Not assets at all. They are shown as assets in the financial statements only for the time being. Fictitious assets, expenses or losses which are fully written off are not offset in the profit and loss account. This is what, by making these arrangements, we can have the capital reductions and this left amount can be transferred to the capital reserve account by having the general entries in the books of company. These are the few accounting entries given below. These would be helpful when any reduction or alteration or any arrangements done in the company. If you go through the journal entries, it would be helpful in solving the further problems. Let us move on to the external reconstruction. Once we have understood the internal reconstruction, now it is important to know what external reconstruction means. It takes place when an existing company goes into liquidation for the express purpose of selling its assets and liabilities to a newly formed company which is generally owned and named alike. That means it is similar to amalgamation. Given below is similar to amalgamation but not exactly the same. I have given the complete explanation of how it is to be done. Not only the amalgamation like mergers and demerging of the company. In external reconstruction, a new company is formed for the purpose of taking over the business of an existing sick company which has incurred huge losses and is facing financial difficulties. As we have already discussed, the purpose to form a new company is taking over the business of an existing company. When a company is suffering losses for the past several years and financial difficulties, not only that, and has incurred huge losses, the company can sell its business. It is mentioned over there in our definition that a purpose of selling its assets and liabilities to a newly formed company. So why it is done? The company can sell its business to another newly formed company. Selling its business again gives us a clarity that a new company would be taking over the assets and also the liabilities of the old company. When after happening this, the liquidated company is called vendor company and the newly company is called purchasing company. So the shareholders of vendor company become the shareholders of purchasing company. So these are the few points we have understood under the external reconstructions. Now once we have understood the external reconstructions, let us go through the few differences, that is a distinguish between the internal and external reconstructions. There are various differences we have. To just have few gist of that internal and external reconstruction is given below. Nothing but that existing company is not liquidated. Existing company is not liquidated and the external reconstruction under that existing company is liquidated. Here in the first point, existing company will make only some rearrangements but not go into liquidation. But in case of external reconstruction, as it will be liquidated. The next point, no new company is formed. As we have already discussed in our external reconstruction explanation, so where no new company is going to form, only it will be rearranged by having some rights of the shareholders and creditors, only the few changes will be made. Whereas in external reconstruction, a new company is formed to take over the liquidated company. Because it is to be formed as it is going to liquidate, a new company is to be formed. But in case of internal reconstruction, only the generally owned and named will be alike. The very next important point is there is certain reduction of capital and sometimes the outside liabilities like debenture holders may have to reduce their claims. What actually is reduction of capital in the sense? Here capital is reduced and the external liability holders waive their claim, or they will reduce the capital on agreed upon some discount to reach for your capital reduction. So whatever the left out amount in the capital reduction, that can be transferred to the capital reserve account. To have more rearrangements will be done. And in case of external reconstruction, there's no such kind of reduction will happen. So there are other few differences we have, like in internal reconstruction, no such transfer takes place for assets and liabilities of existing company, and in case of external reconstruction, as the company get liquidated, so all the assets and liabilities of that existing company has to be transferred to the newly company. So these are the few differences of internal and external reconstruction. Here we have now one example problem is given to understand how the capital reduction is to be arrived. So, and first question is on the reconstruction of a company. Here the company is going for the reconstruction. And for going for the reconstruction and for making any further rearrangements, the following terms and conditions to be agreed upon by the liability holders. That is very important because based on their agreed upon whatever the terms and condition, then the company will go for the
further rearrangements. Here the shareholders to receive in place of their present holding, that is an equity shareholders, that is an equity shares have been given here 50,000 for rupees 50 each. This is nothing but that this is showing in the existing balance sheet. And the shareholders to receive the followings, and the shareholders are now agreeing upon for the following to make some rearrangements in the company. So the first point is fully paid equity shares 2/5 of their present holdings. So this is nothing but that whatever the present equity we have, it is nothing but that existing. So whichever the existing equity shares we will consider as an old equity share capital. And because of the new things what we are taking into account, that will be considered as a new. New is nothing but that we are making the rearrangements for the existing share, that is an equity share capital. So here second one is also given for the changes in the preference shares. 5% preference shares fully paid. This is nothing but that it is already been existed in the balance sheet, and what is the changes they are doing, 1/5 of the above new equity shares. Whatever the new equity shares we have taken, from that they are considering the other few changes. And then third one, the third adjustment says here rupees 60,000 in debentures. Now we have to prepare a capital reduction account. If these adjustments is being given for the company, reconstruction of the company, these are all the general entry. One general entry has been passed for the above adjustments. So now we have taken the preparation of capital reduction account. First, we have to take into consideration that whatever is an existing balance sheet is showing as old equity share capital. So as there is shown here 50,000 into 5, that is in 50,000 equity shares of rupees 50 each. If you multiply that, you will arrive for 25 lakh. The next adjustments what we are going to take is nothing but, so now out of this capital, that is an old equity share capital, first adjustment is towards the equity shares. New equity shares have been agreed upon by the shareholders. So 2/5 is to be taken out of this old equity. 25 lakh into 2/5 if you do, you will get 10 lakh. The second adjustment is 5% preference share, is that is nothing but existing balance sheet is showing the 5% preferences which was fully paid, and now the new changes they are making of 1/5 of the above new equity shares. So new equity shares we are taking that new equities whatever we have arrived it for 10 lakhs, out of that they are agreed upon for 1/5. So that calculation if you do 10 lakhs into 1/5, you will get 2 lakh. The next adjustment if we take, directly it is given that 60,000 in debentures. So the 60,000 debentures we have directly taken as an account, and then if we add all the three new adjustments, that 10 lakh plus 2 plus 60,000, you will be minusing or deducting that from the old equity. So after you are minusing that 25 lakhs into 12 lakh 60,000, you will be getting the balance of 12 lakh 40,000. That will be considered as your capital reduction. That is nothing but the, we have made some reductions, that is in reducing the capital. So to arrive on capital reduction, that amount is 12 lakh 40,000. So capital reduction is nothing but the balance left out that can be directly transferred to the capital reserve account, which is being shown in the capital reduction reserve account. One small ledger has been taken into consideration to understand that how the capital reduction is transferred to the capital reserve account. So whatever we have arrived at, the total 12,40,000 is transferred to your capital reserve account. Now the company, after going into the reconstruction by few conditions, terms and conditions, the company is now having the capital reserve with the amount 12,40,000. So this is the question given as an example to pass the journal entries for making these changes, and we'll go to the next slide where you will be getting the another few more general entries. Now, all of you have understood the first problem of how the company going to reconstruction by making few adjustments in the capital, that is in share capital. But the second problem have more adjustments done in the company for their internal reconstruction. So now we will learn few more adjustments. Here, ABC Company Limited has going into the internal reconstruction with some following terms and conditions given over there. 80,000 equity shares of rupees 10 each fully paid. This is nothing but that the figure what it is showing is from the existing balance sheet. Now which is to be converted. Converted is nothing but that now we are taking into the new account, that is nothing but the rearrangement is done by reducing the capital. So converted into 40,000 equity shares of rupees 5 each. So the second adjustment is 4,000 12% preference shares of rupees 100 each fully paid. So this is also been taken from the existing balance sheet of the company, and now the new things we have to converting that into the 40,000 equity shares of rupees 5 each, which is also been fully paid for the purpose of reconstruction to ascertain the capital reduction. The next adjustment is 615% debentures of rupees 1000. So this is been given or taken from the balance sheet, which is to be discharged by the issue of 80,000 equity shares of 5 each fully paid. So this debentures is against the equity share capital. So by issuing the equity share capital, these debentures can be discharged. The amount so available is appropriated to written off. We had discussed in earlier first slide that few things, whatever the losses we have, that is an accumulated loss and fictitious assets to be written off. For the purpose we are going to have this capital reduction. So now here the company is going under few terms and conditions. So once if you get some amount from the capital for the purpose of, that is in reconstruction purpose, whatever the amount we get for the capital reduction, so from that the following can be written off, that is in nothing but the profit and loss account, debit balance of 4 lakh, goodwill rupees 2 lakh, and plant and machinery for rupees 1,50,000. These are the three different items to be written off only when they get the appropriate capital reduction. So out of that, if any amount after going all the adjustments and deductions, any amount is left out, then later it can be transferred to the capital reserve account. Let us go to the journal entries so that you will understand how the company is going with the adjustments and rearrangements to ascertain the or to bring a result of capital reserve account. So like how in the previous problem we had taken the old equity share capital. This will be directly from the existing balance sheet. We have taken the equity share capital old 80,000 into 10. So it comes to 8 lakh. So now whatever the new changes they have agreed upon, so that is the new shares 40,000 of 5 each, it is being given fully paid, so that comes to 2 lakhs. So the whatever remaining from the 8 lakhs and then the changes what happened is 2 lakh. Now the remaining balance is being transferred to the capital reduction account, where you can see in the narration we have mentioned being conversion of 80,000 equity shares of rupees 10, and then new equity it becomes for 40,000 equity shares of 5 each. So the balance is now we are keeping as a capital reduction after the new equity is being issued. The second adjustment is for the preference share capital. As an old we are showing, old is nothing but this is being taken from the existing balance sheet. So now the existing balance sheet shows as 4,000 into 100 fully paid. It comes to 4 lakhs, which we have already been debited. And the new share capital, which is to be credited as 40,000 into 5, which is also been fully paid, and we are going to transfer, we are taking it from the equity share capital account. So that comes to 2 lakhs. So now from 4 lakhs to 2 lakhs it has been reduced, and the remaining it is understood seeing the debit entry and to the credit entry of 4 lakhs and 2 lakhs, remaining is 2 lakhs we have. So that is directly being transferred to the capital reduction account. So as we are reducing the share capital, we are coming and we are arriving a result of capital reduction. So it is being shown in your narration, being 12% preference shares converted into 40,000 equity shares of rupees 5. The very next adjustments what we have about the debentures. Here the debentures what shown in your balance sheet. So whatever the figure it is given, that is from the balance sheet is being taken. So 50% of 600 into 1000, it comes to 6 lakh. It is now what we are issuing for the new, that is been the debentures will be cleared by issuing the equity shares of 80,000 into 5, 4 lakhs. So now the remaining is 2 lakhs. So that will be transferred to your capital reduction account. So the debenture, 15% debentures are now discharged by issuing the equities, and the balance as you see in the narration, it is shown over there. It is transferred to the capital reduction account. Last, it is about return of all accumulated losses and the balance. See here, capital reduction account. How we have arrived these 10 lakhs. See all the three general entries above where we have been balanced is being shown as a capital reduction. So right from the first general entry 6 lakh, and the second entry what we have arrived for 2 lakhs, and in the third capital reduction what we have got 2 lakhs. So if you add 6 plus 2 lakhs plus 2 lakhs, so it comes to 10 lakhs. So your total capital reduction after the rearrangements is now showing as 10 lakhs. So that against that 10 lakhs, we are going to have some written off against this losses. So for capital profit and loss account, which is already been given in your question, that is in 4 lakh, and goodwill 2 lakhs, and plant and machinery is 1 lakh 50,000. So all these three, only three amounts, and the three different figures have to be added, and if you deduct that from your capital reduction, so the balance left out, so whatever is the balance, if any balance left out it in from the capital reduction, so that should be transferred to the capital reserve account. So the balance figure is shown, it is directly given in the capital reserve account, where the company after reducing from the share capital based on the agreement of the there's an agreement of the liability holders. So the last but not least, the reserve capital they will arrive, that is nothing but the balance figure for meeting their future contingencies. We have one more problem to understand the changes in the company for the purpose of reconstruction. So here the X company limited having the following details. Whatever the details they have given here, they have taken and extracted from the existing balance sheet, and they are asking us to have the changes. These are nothing but that being agreed upon on the liability holders. We have made some changes over here. Based on that, we have to pass the journal entries to reach for the capital reduction, and later left out balance can be transferred to the capital reserve account. So the first 10,000 of 6% preference shares of rupees 100 each, 50,000 equity shares of rupees 10 each, the shares were fully paid. The company has accumulated losses to the extent of rupees 3,50,000 preliminary expenses of rupees 20,000 and fixed assets are valued to the extent of rupees 4 lakh. The scheme of capital reduction permits to write off overvalued of fixed assets, losses and expenses. Under this scheme, 6% preference shares are to be converted into 7.5% preference shares of rupees 60 each, and equity shares are converted into of rupees 2 each. Here for the equities and preference shares, it is given in the fourth point, the scheme of reduction after the return of. Here the overvalued of assets and the losses and expenses to be considered in the last. So first let us have for the equity share capital. Equity share capital is old 10 into 50,000 share, equity shares of 10 each, that comes to 5 lakhs, nothing but the old equity share capital. And now the new changes what we have is 50,000 into 2 each is asked for the changes. So we have made the changes and it has arrived to 1 lakh. So that 5 lakh into 1 lakh minus, if you deduct that out of 5 lakhs, 1 lakh of new equity share capital, the balance is 4 lakhs which is to be transferred to the capital reduction account. So second, 6% preference share capital, it comes to 10 lakhs, and the new preference share capital which is asked for the adjustment, that is to be converted into 7.5 preference shares of 60 each. So we have done it here and it has come to 6 lakh. So the remaining out of this 10 lakhs to 6 lakhs, whatever the balance, it is to be transferred to your capital reduction account. So if you refer and read the narration, you will understand how this journal entry has passed and what the changes from the old end to the new is done. And the third is last, that is nothing but the reduction, capital reduction to write off the accumulated losses. So out of your capital reduction account, this amount will be arriving from the above two journal entries where you have transferred the capital reduction for 4 lakhs and another one 4 lakhs. So 4 lakh plus 4 lakh, it comes to 8 lakhs. So that can be written off to profit and loss account 3,50,000 and preliminary expenses 20,000, fixed assets which has been revalued to be shown as 4 lakh. So all these three amounts which is written off to be added, and you have to deduct it from the total capital reduction account. Whatever the balance you arrive after ascertaining this balance is to be transferred and shown as capital reserve account. So this is what the three problems we have shown, and the next, this might come under the section B for 6 marks. So please refer all the journal entries and read the questions perfectly so that too it becomes easy for you to pass the journal entries. Always see that existing amounts and whatever is to be converted, it is nothing but the new changes what you are making, for that the journal entries is to be passed, and finally you will arrive to the capital reserve account. So further problems you will understand more what the reconstruction happens in the company by agreeing upon the few more changes in the company. The problem is here. In this problem, the balance sheet of XYZ Limited is given over here. So earlier only we had extracted the alterations, but here it is given along with the balance sheet. So we have the few terms and conditions regarding the alteration and either to reduce or to increase the assets. So let us first see the liability side. Few items have been given, and on the asset side, as usual, the asset side, all the items have been given over there. Here, the following schemes was approved by the court of the company. That is nothing but for any alteration or for the reconstruction. So there should be some changes. So that is what it is given in this sentence. So this approved by the court, and then later the company has agreed to make these changes in the following. So first let us understand each and every point given over here. That is nothing but the alterations in your problem. So if you understand this carefully, it helps you in passing the journal entries. So the first, as usual, preference shares to be reduced. Here we have already the balance sheet, it is shown 4,000 preference shares of 100 each. So for that there is an alteration for preference shares. It is asked to reduce to rupees 75 per share, and equity shares to be reduced 37.5. So same as it is like how we were doing the changes for the preference and equity share capital for showing the old and new to be passed to know the difference, and that difference to be transferred to the capital reduction account. And let us go to the second adjustment, and here debenture holders to take over stock and debtors in full satisfaction of the amount due to them. Here the adjustments says here debenture holders. The debenture holders to take over stock and debtors, in the sense, so they are taking over the stock and debtors, whatever the due they are having in their account. So what is the condition of the debenture holders here, in the sense? In full satisfaction of the amount due to them. So whatever the amount due to them in their account, the debenture holders account, that will be taken over against stock and debtors. Here the two general entries we have to pass. One, first we have to show the debenture holders how much account is remain in their account. That is, that you can easily see in your balance sheet. So mortgage debentures 2 lakhs. First we have to pass the general entries how much amount is in their account and what is due to them. So that general entry is to be shown that this much of amount is there in debenture holders. And then later one more general entry is to be passed saying that debenture holders how they are taking over stock and debtors against their account, that is an amount due to them. So two general entries to be passed here. Goodwill to be eliminated completely. It is saying here, so whatever the goodwill shown in the asset side, that is 30,000, it is to be written off completely. The company has decided to written off that completely against the capital reduction amount. And the very next alteration is freehold premises to be depreciated by 50%. Here it is nothing but the freehold premises given in your balance sheet and the asset side for rupees 4 lakh. That is to be depreciated for 50%. It is to be reduced. So for that is another kind of alteration done in your company. The next is plant to be appreciated by rupees 1 lakh. Here plant and machinery is given 6 lakh in your balance sheet, where they are asking here to increase, that is appreciated is nothing but increasing the amount which can be taken into account for 1 lakh in your passing the journal entries, and later this will be taken into consideration as a capital reduction. So now let us go to pass the necessary journal entries for given this problem. Now we have understood the adjustments, seeing the balance sheet of the company. Now we will go and move to the necessary journal entries to be passed. I have made you understand the question and the adjustments given for the XYZ company limited. Let us have the solution how the journal entries is to be passed based on the following alterations. First, as given in the question, preference share capital it is to be reduced. First we have to take and show in your journal entries the old preference share capital given as 4,000 preference share capital of 100 each, it comes to 4 lakhs. So that we have already debited over there. And the new preference share capital is to be credited with the changes of 4,000 preference shares of 75 each. There, here it has been reduced and the amount comes to 3 lakh. So after passing this debit and credit with the old and new, so you are getting 4 lakh and 3 lakhs. Once if the balance shows is 1 lakh. So this is to be transferred to the capital reduction account and it is to be shown in a credit entry saying to capital reduction account of 1 lakh rupees. Now this next second entry related to equity share capital. Same as earlier problem. Here first all equity share capital is to be shown, which is 8,000 equity shares of 100 each. It comes to 8 lakhs. New equities, it is to be reduced for 37.5. It is to be for 8,000 into 37.5 comes to 3 lakh. So as per your old equity and the new equities, if you take into consideration for debiting and crediting to your new equity, so the balance shows 5 lakhs which is to be transferred to the capital reduction account. So your credit entry is to capital reduction account for rupees 5 lakhs. So two general entries we have done with the preference and equity share capital. Now next come to the debentures. As I had explained to you in a question, seeing this alteration, here the debenture holders are agreed to take over the stock and debtors. So first we need to show how much is due with the debenture holders. So 5% mortgage debentures account 2 lakhs. With this we have taken from the balance sheet. In the existing balance sheet, like how we were showing in the earlier, same in we have extracted this from the balance sheet. So it is shown on the debit side 2 lakhs and to the debenture holders account. So this gives an understanding that crediting these debenture holders, it is balance remain with them which is due to the debenture holders. So in narration it is shown being the amount due to debenture holders. So the 2 lakhs is due to the debenture holders. On this general entry is passed. So the related to that, whatever is due to the debenture holders, it is to be taken over against stock and debtors. So first debenture holders account data, which we had shown earlier to the credit entry 2 lakhs. So now we are showing it to the debit. So 2 lakhs. So credit entry to stock 1 lakh rupees as it is shown in the question. So debtors 80,000. Against these two, the amount is cleared off to the debenture holders and the balance remain 20,000 is shown towards capital reduction account. So to capital reduction account is shown for 20,000. So by this adjustment, by reducing the capital reduction, so we have already got the 20,000 by this adjustment. So it is shown in the narration also being the assets taken over by the debenture holders. Now next plant and machineries, which is to be shown as an appreciation. So a separate journal entry is to be passed as there is an increase in the value of plant. So this also will be accumulated and added in your capital reduction account. So as there is a value is increased, plant and machinery account data we are showing as same in the question it is given 1 lakh rupees. And then to capital reduction account. So the increasing in the value of any asset will be directly to transfer to the capital reduction account. 1 lakh rupees is shown over there. So the next is, so whatever we have accumulated the capital reduction account, the total right from the first, second and third and fourth general entry, if you add all the capital reduction account, that is 1 lakh and 5 lakhs, and then is another amount which is to be shown, and we have shown there 20,000. If you add this plus the capital that is in plant and machinery appreciated. So that also 1 lakh. So total it comes to 7,20,000 capital reduction account. Against this capital reduction amount, the company agreed to write off the following. That is goodwill for 30,000 and depreciation on freehold premises 2 lakh, to profit and loss account 4,90,000, where these are the few fictitious assets written off and other assets also adjusted to its true value. So it is no balance remain over there. So this amount is already been adjusted, whatever the capital reduction is accumulated out of the following alterations. So there is a no balance left out. So we have no amount to transfer to the capital reserve account.
As I have covered internal and external reconstruction and few problems on capital reduction account. Hope you have understood the concept of reconstruction and journal entries to be passed by understanding the terms of the company. In my next video, internal reconstruction part 2, in which I would be taking you to reconstruction of balance sheet, which is for section C. Do not forget to watch part 2 to learn few more problems. Thank you for watching.